All right, so mutual funds can be a little bit of a maze,
Yeah.
even for those of us who've been investing for a while.
Yeah.
But you know what? Today's deep dive, it's all about making this simple, especially if you are just starting to think about growing your wealth.
Yeah. It can be intimidating
For sure.
when you're starting out.
Like, where do you even begin?
Yeah.
So we've got this awesome guide. What are mutual funds? A beginner's guide to smart investing. And I have to tell you, it has busted some myths I had about mutual funds.
Oh, really?
I didn't realize how powerful this investing tool really is and how easy it is to get started.
Yeah, it's a great way to get going.
It really is. So what are we going to unpack today? We're going to break down exactly what a mutual fund is.
Okay.
Think of it like a slice of delicious pie.
I love that.
Right.
The pie analogy is great.
It just clicks.
It does.
Then we'll explore the different flavors out there.
Ooh, I like that.
Right.
Yeah.
Because there's a whole bunch of different kinds of mutual funds. And get this, we'll even walk through a real-life example of how someone, maybe even you listening, could start benefiting from this approach to investing.
Awesome. Can't wait.
Okay,
Yeah.
so enough teasing. Let's answer the million-dollar question. What in the world is a mutual fund? I was blown away by this pie analogy in the guide.
I know, right?
It just makes it so clear.
Yeah, it's brilliant for visualizing diversification. So picture a pie packed with ingredients, stocks, bonds, maybe even a little sprinkle of real estate.
Okay,
That's your mutual fund.
so you're not betting on one stock hoping that single company takes off.
Exactly.
You're spreading your risk across this whole mix of ingredients in the pie.
You got it.
Brilliant.
And here's where it gets even better. You're not alone at this pie party. Mutual funds pool money from tons of investors, allowing everyone to benefit from a professionally managed portfolio.
Okay.
You don't have to be an expert stock picker. There's a pro chef, so to speak, handling all the ingredients.
All right, I'm already feeling smarter about this, but how does this pie actually translate into, money in our pockets?
Well, think of it this way. Your slice can become more valuable in a couple of ways. First, capital gains. That's when the value of the entire pie goes up, meaning your slice is worth more than what you initially paid.
Gotcha.
Second, dividends. Those are like little bonus bites of income that the pie generates. It's like getting paid just for owning a slice.
Okay.
Pretty great, right?
All right, I'm loving this pie metaphor. So the pie itself can grow, plus it generates extra income. Sign me up. But now I'm kind of curious about the different kinds of pies, or in this case, types of mutual funds. I feel like there's a whole world out there to explore.
You're right. There is. It's almost like walking into an ice cream shop with endless flavors.
Ooh, that sounds fun.
It is.
Right.
So let's start with a classic, the vanilla of mutual funds, equity funds.
Equity funds, so those sound familiar. Aren't those the ones that invest mainly in stocks?
Exactly. They primarily target stocks, which is where the potential for high growth comes in. Think of companies like Amazon or Tesla.
Yay.
Their stocks can have huge jumps in value, and with an equity fund, you're riding that wave, but with less risk because you're diversified.
Right, you're not putting all your eggs in the Amazon basket. You've got a bunch of other companies in there too.
Right, exactly.
Okay. So if equity funds are the high growth, maybe slightly riskier option, what about something a bit more laid back?
Well, that's where bond funds come in. Imagine like a comforting bowl of soup, steady and reliable.
Okay, I like it.
Bond funds invest in bonds, which are like loans to governments or companies. They offer regular income in the form of interest payments and tend to be less volatile than stocks.
So bond funds are like the safe bet, slower and steadier wins the race kind of thing?
You could say that.
I could see how that would appeal to some investors.
It depends on your goals and your risk tolerance.
Right.
But what if you want a bit of both? A taste of that exciting high growth and some steady income on the side.
Now you're speaking my language. Is there some kind of a hybrid pie for that?
There is. We call those balanced funds. They blend stocks and bonds, offering like a middle-of-the-road approach. You get some growth potential, but also some stability to cushion potential dips.
Okay. I'm already starting to see how much sense these mutual funds make, especially for someone like me who's still learning the ropes. But before we get too deep into how to actually choose a fund, there's a couple more types we should touch on, right?
Yeah, there are.
Let's do it.
Let's briefly cover money market funds. They're considered ultra safe, almost like keeping your money in a savings account, but with a slightly better interest rate.
So not necessarily for huge growth,
Right.
but for keeping your money safe and still earning a little something.
Exactly. Now, there's one more type that's especially popular for beginners, and for good reason, index funds.
Index funds. Those have been
Cool.
popping up everywhere lately. What's the deal with them?
So imagine a mutual fund that simply mirrors a specific market index like the S&P 500.
Okay.
If the S&P 500 goes up, your index fund goes up.
Gotcha.
They're passively managed, meaning no fancy stock picking, so fees are really low.
Sounds pretty straightforward and cost-effective, too.
It is.
Is that why they're so popular with beginners?
Yeah, low cost, easy to understand, broad market exposure. It's a winning combo.
Makes sense.
Yeah.
Okay, so last one we've got sector funds.
Yeah?
Those are kind of niche, right?
Yeah.
So if I have a hunch that, say, renewable energy is going to boom, I could invest in a sector fund focused specifically on that industry.
You could, but just like with any focused bet, there's more risk involved.
Okay,
If that sector doesn't perform well, your investment takes a hit.
gotcha.
So that's something to keep in mind.
All right, so we've got our grand tour of the mutual fund flavors. We've got equity funds, bond funds, balance funds, money market funds, index funds, even these niche sector funds. Wow, there's truly a fund for every taste.
I know, right?
It's like going to a buffet.
It's all about finding the right fit for your goals and risk tolerance.
Exactly. But I'm curious, what makes mutual funds, in general, so well suited for beginners? There are tons of ways to invest, so what makes this such a great starting point?
Well, that's a great question. And it gets to the heart of why we're doing this deep dive. There are actually 5 key reasons why mutual funds are particularly beginner-friendly, and I think they'll surprise you. First up, diversification.
Ah, yes. Back to our pie analogy. It's
Aye.
like not putting all your eggs in one basket, spreading the risk across multiple ingredients.
Exactly. And mutual funds do this automatically. They spread your investment across a variety of assets. So even if one stock or bond stumbles, it's less likely to sink your entire portfolio.
Makes sense. You're not banking on one single thing to succeed. It's like having a safety net built in.
Okay.
What's the next big perk?
Professional management.
Okay.
This is huge for beginners. You don't need to spend hours researching companies or trying to predict the market. Fund managers do all the heavy lifting using their expertise to make decisions that align with the fund's objectives.
Wait, so it's like having a personal financial advisor, but without the expensive fees.
You could say that.
Nice.
And it gets even better.
Oh.
Mutual funds are incredibly accessible. You don't need to be a millionaire to get started. Many funds have low minimum investments, sometimes as low as $100.
Okay, that's encouraging to hear. You don't need to be rolling in dough to start building wealth. I'm assuming this ties into the next benefit. Liquidity.
It does. Liquidity means how easily you can buy or sell an asset. With mutual funds, you can typically trade shares on any business day, so accessing your money is pretty straightforward.
So no getting stuck with an investment you can't get rid of. Got it. All right, what's the 5th and final reason why mutual funds are such a winner, especially for beginners?
Cost effectiveness. Especially with index funds and ETFs, their fees are typically far lower than actively managed funds. This means more of your money stays invested and working for you, not going to fees.
Okay, so to recap, we've got diversification, professional management, accessibility, liquidity, and they're cost effective. I mean, it's almost like mutual funds were designed with beginners in mind. But let's be real.
Okay.
It's got to be a cash, right?
You're right to be skeptical. Like any investment, it's crucial to understand both the good and the bad. And yes, there are a few potential drawbacks we need to discuss. It's always wise to look at both sides of the coin, you know. One thing to consider is that mutual funds do come with management fees.
Okay,
They're expressed as an expense ratio.
right. The expense ratio.
Yep.
That's the percentage of your investment that goes towards paying the fund managers and covering all the operational costs, right?
Precisely. And while index funds and ETFs tend to have very low expense ratios, actively managed funds can have higher fees, so it's essential to factor those into your decision making.
So being fee conscious is key.
Yeah.
What other potential downsides should we be aware of?
Well, here's the truth bomb. There are no guarantees in investing. Mutual funds, like any investment, are subject to market risks, which means the value of your investment can go down.
So even with all the diversification and a pro at the helm, there's still a chance you could lose money.
It's a possibility, yes, but here's the key.
Okay.
Think long term. The market will always have its ups and downs, but historically over the long haul, it trends upwards. It's about weathering those storms and sticking with your strategy.
Okay, so patience is a virtue, especially when it comes to investing. It's not about getting rich quick. It's about steady growth over time.
Exactly.
Are there any other drawbacks we should be aware of?
One more thing to mention, mutual fund gains are taxable, even if you choose to reinvest them.
Ah, so even if I'm letting my money grow and compound within the fund,
Mm-hmm.
I still need to be mindful of the tax implications.
Yeah.
Good to know. All right, we've laid a solid foundation. We understand what mutual funds are, different types, the benefits, and even the potential downsides. Now let's talk strategy. How do we actually get started with investing in these things?
Well, luckily, our guide provides a pretty clear roadmap to get you going. It all starts with something surprisingly simple: defining your financial goals.
Ah. So before we even think about stocks and bonds, we need to figure out why we're investing in the first place.
Exactly. Are you saving for retirement, a down payment on a house, your dream trip around the world? Your goals will shape your investment strategy and help you determine what type of mutual fund is the right fit.
So a long-term goal like retirement might call for a different approach than a shorter-term goal like saving for a vacation.
Exactly.
That makes a lot of sense. Okay,
Right.
once we've got our financial way figured out, what's the next step?
Time to open an investment account.
Okay.
This is your gateway to the world of mutual funds.
So where do we go for that? The guide mentions platforms like Vanguard, Fidelity, Charles Schwab, and Robinhood. Are those good options?
Yeah, those are all reputable platforms that offer a wide range of investment choices, including mutual funds. Many of them have low-cost options, which, as we've discussed, is super important.
Fantastic. So we've got our goals in sight, our account is open, and now it's time for research.
Okay.
This is where you roll up your sleeves and explore the different funds out there, looking for those that align with your goals and your risk tolerance.
It's like browsing a menu, but instead of delicious dishes, we're comparing investment strategies. What should we be paying attention to when we're doing this research?
There are a few key things. Expense ratios are crucial, of course. You also want to look at past performance, although, remember, past results don't guarantee future success.
Right.
But it can give you a sense of how a fund has historically performed.
So like checking the reviews before you choose a restaurant.
Exactly.
Solid advice. Anything else we should consider?
Definitely look closely at the fund's objectives.
What are they aiming to achieve? Is it growth, income, or a blend of both? Make sure those objectives match up with your own financial goals.
Got it. So we're not just picking a fund based on a catchy name or impressive past returns. We're really doing our homework to find the right fit.
Right.
Once we've found a potential winner, what happens next?
It's time to take action. Step 4 is all about starting to invest. The guide recommends a strategy called SIPs, systematic investment plans. You might know it as dollar cost averaging in the U.S.
Dollar cost averaging, that rings a bell. Isn't that where you invest a fixed amount at regular intervals, like monthly?
You got it. This helps smooth out the bumps of market volatility because you're buying at different prices over time.
Okay.
It takes the pressure off trying to perfectly time the market, which, let's be honest, is nearly impossible.
I love that. It's like setting it and forgetting it consistently, building your investment over time. Sounds a lot less stressful than trying to be a market timing guru. Okay, last step on our mutual fund adventure.
Monitor and review. Investing isn't a one-time thing. It's about checking in on your funds periodically to see how they're performing and making adjustments if necessary.
So it's like tending a garden. We've planted the seeds, but we still need to water them, prune them, and make sure they're thriving. What's the best way to go about this monitoring and reviewing process?
Well, it depends on your comfort level and the platforms you're using. Most investment platforms provide tools and resources to track your portfolio's performance. It's also a good idea to schedule regular check-ins, maybe quarterly or annually, to assess your progress and see if any adjustments are needed.
Okay, so regular checkups are key. Now, I think it would be super helpful to ground all this information in a real-life example. The guide talks about Sarah, who uses mutual funds to save for retirement. Can you walk us through her journey and how her investment grows over time?
Absolutely. Sarah's story perfectly illustrates the power of consistency and the magic of compounding. She's a 30-year-old professional who decides it's time to start saving for retirement. She opens an account with Vanguard and commits to investing $500 per month in an S&P 500 index fund.
Okay, so she's starting early, choosing a low-cost index fund, and setting up a regular investment plan.
Yep.
Sounds like she's off to a great start. What happens next?
Well, assuming an average annual return of 8%, after 10 years, her total investment of $60,000 grows to nearly $92,000.
Wait, hold on. She nearly doubles her money in just 10 years. That's incredible.
It is.
And to think that's with relatively small, consistent contributions.
Exactly. And that's just the beginning. Imagine the growth potential over 20 or 30 years. That's the beauty of compounding. Your money earns interest, and then that interest earns interest, and so on. It's like a snowball rolling downhill, getting bigger and bigger.
Sarah's story is so inspiring. It really highlights that you don't need to be a financial whiz or have a ton of money to start investing and building wealth.
Right.
Consistency in choosing the right tools like mutual funds can really pay off in the long run.
That's the key takeaway. Mutual funds can be a powerful ally on your journey to financial security, whether you're saving for retirement, a down payment, or simply growing your wealth.
Before we wrap up this deep dive, I'd love to leave our listeners with some actionable advice. What are some key tips for success that we've gleaned from our guide and our conversation today?
Let's distill it down to a few golden nuggets.
Yeah.
First and foremost, as we've already emphasized, start early.
Okay.
Time is your most valuable asset. The sooner you start investing, the more time your money has to work its magic through compounding.
I'm hearing that loud and clear. Don't wait. Start investing now. Even small amounts can add up over time.
For sure.
What else should we keep in mind?
Choose low-cost funds. We talked about how fees can eat into your returns. Index funds are often a great choice for beginners because they offer diversification at a very low cost.
Index funds. Simple, affordable, effective. I'm starting to see why they're so popular. What other tips can help set us up for success?
Here's a big one. Stay consistent even when the market gets bumpy. It's easy to panic and sell when things are down, but remember, investing is a long game.
Oh, wait.
Stay the course, keep investing regularly, and trust that the market tends to rebound over time.
Okay, so resist the urge to emotionally react to market fluctuations.
Yes.
Stay calm, stay consistent. What else?
Reinvest your dividends. Don't cash them out. Let them work for you by getting reinvested back into the fund. This amplifies your returns through the power of compounding.
It's like earning interest on top of interest.
Exactly.
I can see how that can really accelerate growth.
Yeah.
Any final words of wisdom?
If you're feeling overwhelmed or unsure about any of this, don't hesitate to seek professional advice. A qualified financial advisor can provide personalized guidance and help you create a plan that aligns with your specific goals and risk tolerance.
Great advice. There's no shame in asking for help, especially when it comes to something as important as your financial well-being. Okay, we've covered a lot of ground today. We've learned what mutual funds are, explored the different types, weighed the pros and cons, and even got some actionable tips for success. I'm feeling a lot more confident about this whole investing thing.
That's great to hear. We've demystified a complex topic and hopefully empowered you to take control of your financial future. Remember, investing doesn't have to be intimidating. With the right tools and knowledge, it can be an exciting and rewarding journey.
I couldn't agree more. But before we wrap up this episode, I want to leave our listeners with a final thought, a question to ponder as they embark on their own investing adventures.
Ooh, I love a good thought-provoking question. What do you have in mind?
Well, we've explored a diverse menu of mutual funds, each with its unique flavor and characteristics. So my question is this: what kind of fund resonates most with you and your individual goals and risk tolerance?
That's a fantastic question. It really challenges our listeners to take everything they've learned today and apply it to their own unique situations. There's no one-size-fits-all answer when it comes to investing.
Exactly. It all comes down to your individual needs and aspirations. What are you saving for? How much risk are you comfortable with? These are all crucial factors to consider when choosing the right mutual fund for your journey.
And remember, there are resources available to help you along the way.
Yes.
Don't be afraid to reach out to a financial advisor if you need guidance in creating a personalized investment plan.
Well said. Knowledge is power, and you now have the power to shape your financial future. And as our guide says, the best time to start investing was yesterday.
But the second best time is today.
So true. Don't let procrastination hold you back from growing your wealth.
Time is your greatest ally, so put it to work for you.
This has been such an eye-opening deep dive into the world of mutual funds. I feel like we've taken something that can seem really complicated and made it understandable for anyone.
I agree. We broke it down, into bite-sized pieces.
Yeah.
Used analogies, real-life examples to show just how powerful and yet simple mutual fund investing can be.
Exactly. And I hope our listeners are leaving this episode feeling empowered and excited to start their own investing journeys.
I'm sure they are. We've given them the knowledge, the tools, the inspiration to start building their financial futures one investment at a time.
Well said. And on that note, we'll wrap up this episode of The Deep Dive. Thank you so much for joining us on this journey of discovery. Remember, the world of investing is vast and full of possibilities. Keep exploring, keep learning, and keep growing your wealth. We'll see you next time for another deep dive into a fascinating topic. Until then, happy investing.